The live price for Nuburu Inc. BURU is $0.3377, reflecting a minimal intraday movement following the market close on October 30, 2025. This stock closed the last trading day down, a continuation of the volatility that has defined its recent chart action. Now, the common expectation for a penny stock like Nuburu is to focus squarely on the blue laser technology, the original core business, and the continuous dilution risk. However, that line of thinking misses the major unexpected strategic pivot that is the real driver of this stock's wild swings: the aggressive, almost existential shift into the defense and security sector. This isn't just about selling a few lasers to the military. The company is effectively attempting to transform its entire identity and business model through a string of complex acquisitions and a complete executive shakeup. That is the true tension point for this name: the expectation of a slow-burn technology company versus the reality of a desperate, high-stakes financial transformation plan attempting to bolt a completely different, government-focused business model onto a near-zero revenue base. The market believes this is still a laser company, but in reality, it is rapidly becoming a shell for a new defense contractor with a handful of laser patents on the side. And that is the insight that separates casual observers from serious investors looking at BURU. The daily and weekly swings in Nuburu stock have been a masterclass in low-float, high-volume price action, driven almost entirely by news headlines and speculative retail interest, rather than foundational business execution. We saw a 71% surge in 1 week in early October, followed by rapid retracements, a clear sign of a stock being traded, not invested in. The sheer volume on recent spikes, often dwarfing its average, suggests major short-term players and momentum traders are cycling in and out. Institutional activity, for the moment, remains minimal and fragmented. Yes, major names like Vanguard and Geode Capital Management hold shares, but their overall portfolio allocation to BURU is a fraction of a percent, reinforcing the idea that this is a high-risk, speculative allocation, not a foundational Fidelity Investments holding. We see a few new institutional positions reported, but also decreased and held positions, showing no consensus. The real market momentum has been directly tied to updates on the aforementioned strategic pivot, especially the announcements regarding the Orbit SRL controlling stake in the new Nuburu Defense LLC entity. Each piece of news about securing a contract or advancing an acquisition acts as a brief, violent catalyst, creating the expectation of a significant and immediate re-rating, which then collapses as investors are reminded of the company's precarious financial position. The fact that the stock received a warning letter from the NYSE American LLC for non-compliance adds another layer of fundamental risk that most of the daily trading volume seems to ignore, but which looms large in the background. If you're using an individual brokerage like Robinhood or SoFi Invest to trade this, you need to understand the extreme risk inherent in a stock with this much regulatory and financial uncertainty. The earnings reactions, when they occur, are generally overshadowed by the strategic news. The Q3 2023 results, for instance, showed a loss from operations improvement due to cost reduction, but also a spike in net loss due to a significant loss on debt extinguishment. Crucially, the company has had negligible and recently declining revenue, which throws cold water on the laser tech success narrative. The reality is that the blue laser product adoption cycle is long. Management has quoted 22 to 24 months per customer, and the cash burn has been persistent. This disconnect between the core business's performance and the high-flying acquisition strategy is the core of the expectation versus reality trap for BURU investors. The Nuburu business model, a tale of two companies. What does Nuburu Inc. actually do? This is where the story gets complicated because the answer has changed dramatically. Originally, Nibiru was all about high-power and high-brightness industrial blue laser technology, a genuinely compelling patented technology for welding and 3D printing of reflective metals like copper and aluminum. Think EV battery welding, consumer electronics, and aerospace parts. Blue light is absorbed much better by these materials than traditional infrared lasers, meaning faster, higher quality welds. This is the expectation, a promising, albeit early-stage, deep tech hardware company. The company makes its money by selling and servicing its hardware, such as the AO150 and the BL250 models, and through licensing deals, backed by a portfolio of over 220 patents granted or pending. The reality, however, is that this laser business has failed to achieve meaningful commercial scale. Total revenue has been in the hundreds of thousands of dollars, pitted against an annual net loss in the tens of millions. The transformation plan is a direct response to this failure. The new and increasingly dominant business model is centered on a radical pivot: defense and security. This involves the creation of Nibiru Defense LLC and the Strategic Acquisition Program, targeting companies that specialize in defense tech, security, and critical infrastructure resilience, often through a software-as-a-service model. They are aiming for an entirely new, massive addressable market, leveraging a combination of internal innovation and their newly acquired assets. This is why you see collaborations and deals in the defense space, like the support for a $6.6 million international contract secured by Techne SPA, and the expected finalization of the Orbit SRL acquisition. The new Nibiru is trying to be a defense tech investment holding company first and a blue laser company second. The financial history of the original laser business is one of consistent losses and persistent equity financing. The long-term performance of the stock reflects this, with shares losing significant value over the past year. Dilution has been a recurring theme, with the company leaning on convertible notes and public offerings to raise capital, a necessary evil for a cash-hungry pre-scale hardware startup. For those who invest online using platforms like Interactive Brokers or Fidelity, understanding the impact of frequent equity raises on your proportional ownership is crucial. Every time the company issues new shares to raise capital, your existing stake represents a smaller percentage of the total company. That is the true tension point for this name, the expectation of a slow-burn technology company versus the reality of a desperate high-stakes financial transformation plan attempting to bolt a completely different, government-focused business model onto a near-zero revenue base. The market believes this is still a laser company, but in reality it is rapidly becoming a shell for a new defense contractor with a handful of laser patents on the side. And that is the insight that separates casual observers from serious investors looking at BURU. Future outlook, catalysts, risks, and the reframing of expectation. The future of Nibiru is not about the slow ramp-up of blue laser sales. It is a binary outcome based on the success or failure of its drastic strategic pivot. The catalysts for the stock are tied to the execution of this new vision: successful acquisitions and consolidation. Finalizing the Orbit SRL deal and subsequent acquisitions in the defense and security space is the most immediate catalyst. If they can successfully consolidate these new assets and show a clear path to generating the projected revenue, management has targeted approximately $500,000 in Q4 2025 billings for the new defense segment. That would provide the tangible evidence needed for a major re-rating. The projection of contributing over $50 million in 2025 revenue from the acquisitions, while highly optimistic and contingent on many factors, including U.S. GAAP accounting and regulatory approvals, is the narrative the new management team is pushing. Government contracts and partnerships. demonstrating concrete wins, such as major new contracts secured by the new defense hub with NATO countries or U.S. government agencies, would validate the high-level strategy. Their existing relationships through small business innovation research contracts with the U.S. Air Force and NASA provide a foundation, but the new management needs to turn those seeds into significant, multi-million-dollar bookings. The risks are equally dramatic and directly challenge the new expectation. Execution risk and integration. Transitioning from a single-focus laser hardware company to a multifaceted defense and security conglomerate is a massive undertaking. The risk of management overextending its resources or failing to integrate the new acquired entities successfully is extremely high. The dual CEO structure and rapid management changes are themselves a sign of instability.